Have you ever wondered why most mutual funds, despite their resources and expertise, still struggle to outperform the market? Why do even the best analysts fail to consistently pick winning stocks? Today, we're diving into the world of stock selection for the enterprising investor, as laid out by Benjamin Graham, the father of value investing. Let's explore the hard-hitting truths and actionable strategies that can transform your investment approach. In the previous chapter, we explored the defensive investor's approach, selecting broad groups of securities to minimize risk. But for the enterprising investor, the game is different. The objective? To identify individual stocks that can outperform the market average. Sounds simple? Think again. Graham cautions us that achieving superior returns is far from easy. Despite having access to top-tier analysts, massive research budgets, and advanced market data, most mutual funds still underperform the general market indices. Why? According to research spanning 1960 to 1968, random portfolios of New York Stock Exchange stocks outperform mutual funds in the same risk category. Low and medium risk portfolios achieved 3.7% and 2.5% higher annual returns respectively. Meanwhile, high-risk portfolios only edged out mutual funds by a mere 0.2%. But why is outperforming the market so difficult? Let's find out. Graham presents two compelling reasons why stock selection is such a formidable challenge. First, the efficient market hypothesis, the idea that stock prices already reflect all available information. If true, future price movements would be largely random and unpredictable. Thus, even the sharpest analysts are essentially trying to predict the unpredictable. Second, the herd mentality. Analysts often share information, creating a leveling effect where few can consistently outperform. It's like a bridge tournament where everyone knows each other's cards. Skill alone isn't enough. And what about those analysts who focus solely on high-growth industries? According to Graham, they may be falling into a classic trap, paying any price for perceived quality. But the market doesn't work that way. So, what's the enterprising investor to do? Graham advises a contrarian approach, seeking undervalued stocks ignored by the market. If a substantial segment of the stock market is neglected by conventional analysts, the intelligent investor may uncover hidden gems that the market has overlooked. But to succeed, one must employ unconventional methods, strategies that are sound but unpopular, rooted in deep research and a refusal to follow the crowd. Graham himself built a career and reputation by betting against conventional wisdom, identifying opportunities in areas other analysts ignored. And for the enterprising investor willing to do the hard work, the rewards can be substantial. The lesson? Outperforming the market isn't easy, but it's possible if you're willing to think independently, dig deeper, and act against the crowd. So, are you ready to step up and become a true enterprising investor? The market's opportunities await, but only for those who dare to see what others overlook.